Let's be honest, guys, Friday's close was ugly. We saw the market sold off as three things came together. A much weaker than expected jobs report, oil pushing above $90 now, and rising geopolitical tensions between the US and Iran, which does not seem to be subsiding soon. We are clearly seeing the market starting to price in about stagflation risk once again. And in the technicals chart, we are seeing major indices breaking below their support range that we have been in since December. So in today's market update, I'm going to review everything that happened on Friday, what actually led to it, the latest updates surrounding the war, and my game plan for next week. Now, if you enjoy this kind of market content, do subscribe so that you will always be kept updated of the next video. Now, let's get started. Now, since it is the end of the week, we are looking at the weekly chart for the major indices, and markets are clearly pricing in both economic slowdown and geopolitical risks across all three major indices. Now, when we look at the S&P, you can see that we have closed below this range that we have been in since December 2025. And this is not a very strong signal. And what we are seeing is a very, very crucial support area, right? The market actually closed below that, even though when we see in December, this was actually strong, where the price actually pushed back up to 680. But right now, it actually closed below. So this is a very crucial support area. This coming will be important, and if we do see this range break and geopolitical tensions continue to escalate, we could potentially see the 650 zone right around here being tested along the next few weeks, and this also aligns with the 50 weekly EMA. Now, the Nasdaq is also showing a very similar pattern, also sitting at the key support levels around here. And if this support breaks as well, we could potentially see a move lower towards the 23,800 area, which was also the all-time high area back in August 2025, as you can see on the daily chart around this region. So this also ties into the low that it hit back in November 2025. So that was the weekly, and in terms of the daily, even though we did not close lower than Tuesday, we are still stuck within that range. So it is definitely not as bad as what we saw on the S&P, but this is also a very crucial support level that we want to see the Nasdaq holding. Now, when we look at the Dow Jones, this is actually looking weaker than both the S&P and the Nasdaq together. We actually closed the week down about 2.75%, if I am not wrong. Yes, about 2.7%, breaking below the 48,000 area support, and now testing the December lows as well right over here. So we did actually went lower, and it did close right at the December lows that we saw. So it was a pretty volatile week from there. And what we can see is that equity markets is really clearly reacting to the rising uncertainty. And if we do see that support level breaking across the three indices, at least for the Dow, we might also see tests around the 46,200 region. Now, looking at the daily, where does this line supports at? It also supports at back in the November as well as the October low. So we might potentially see slightly lower around the 45 to 46,000 zone. Now, and we saw this reflected across the market. It's almost the whole market close rate. As you can see, consumer cycles, technology, finance, industrial, everything actually close rate on Friday. Now, what actually happened? So let's look at the main catalyst of what we saw happen on Friday. Now, this was the main thing that caused the market to close red on Friday, and this was a key piece of data, which was the market was reacting to the latest jobs report. Now, the report came in weaker than expected on Friday. The jobs report was expecting to come in at a 58,000 jobs gain, but it actually came in at a loss of 92,000 jobs in February. And this suggests that the labor market might be starting to soften slightly. And normally, weaker jobs data could increase the chance of rate cut, but the market's reaction today wasn't that straightforward, because along with the jobs number, we also saw unemployment rate ticking higher slightly from 4.3% to 4.4%. Now, together with the decreasing jobs report, the rising unemployment rate can signal slowing economic momentum. And that is what investors are paying close attention to, right? There are lesser jobs that are being open, and unemployment rate is increasing. And this is where things get more complicated for the market, because when we look at rate cut percentage for the upcoming Fed meeting on 18th of March, you can see that rate cut from 1 day ago, the percentage has dropped slightly. But when we look further out, we look at the next one that's coming in April, you can start to see the change, which is more impactful, where the rate cut odds have totally decreased as well. And the consensus now is for the Federal Reserve to actually maintain the rate. It actually increased by 6% right over here. And if we look to the next Fed meeting, like the 17th June one, similar occurrence, right? 1 day ago, for the Fed to maintain the rate was at 56%, and now we are seeing it at 66.7%. Now, so what is this market reacting to apart from the jobs data, right? Because with a rising unemployment, with lower jobs, you might think that the Federal Reserve will say, okay, it's time for us to reduce the interest rates, to do rate cuts such that we can spur the economy for people to spend more. But the complication right now comes from inflation risk from oil prices. Now, let's see what is actually happening that caused oil prices to spike up to $90. The first one is we actually saw Kuwait actually cut oil production as fallout from Iran conflict intensified. Now, this immediately raised concerns about global supply, because if they cut oil production, this means supply is going to be reduced. And couple that with what we are seeing with the Strait of Hormuz, when supply tightens with geopolitical risks still rising and no signs of slowing down, this is where we start to see oil prices react quickly. And on top of that, we are seeing reports that Russia is now helping Iran target US military forces. So now Russia is entering the war, and this adds another layer of tension in the region, right? US and Russia, they have debated many times before, and now with Russia entering the scene, right? This is going to make things a little bit more complicated, and markets are particularly sensitive to developments in this kind of area because of the potential impacts of oil supply routes. And you can see that this might actually affect the relationship between US and Russia as well. And there were also comments with Trump calling for what he describes as an unconditional surrender. Now, what can we make of this? Right? Statements like this, when Trump is saying that there will be no deal with Iran, very important, he said no deal with Iran except unconditional surrender. So this gives market the suggestion that the tension is not going to be relieved anytime soon, right? So anything that Trump says and gives some indicator about the tension relieving or the tension that is not going to relieve anytime soon, this will create or lessen the uncertainty. And from what we see now, this is that former, because Trump is basically suggesting that if we don't see any unconditional surrender, tensions could potentially escalate further. And we have seen some more news of the US actually deploying a career strike group to the region, which signals that the situation is actually being taken very seriously from a military standpoint. And this was what was just released, I think, about 12 hours ago. He said that Iran has apologized and surrendered to its Middle East neighbors. Okay, so this is the Middle East neighbor. This is not the unconditional surrender that Trump is looking for. And as you can see, the most important thing is right over here. Right? Today, Iran will be hit very hard. And if you see the language of what Trump is saying, you can see that he is very aggressive, right? Iran is no longer the bully of the Middle East. They are instead the loser of the Middle East, and will be for many decades until they surrender or more likely completely collapse. So as you can see, when markets first hear language like this, the first place they usually look is the oil market, because this is what is affecting it. And that is exactly what we are seeing with oil. Oil prices have been pushing higher, and technically we are starting to see signs of a breakout from the recent range. So this is WTI. You can see that we are testing the September 2023 high. The first high is actually now being tested, and we might see that potential push towards the next high over here, which is that $95, if we don't see any tension escalating. And crude oil is actually, for the past week, it has actually increased the most in many years, actually. As you can see, how was the increase of 36% in a matter of less than 2 weeks. And when we look at Brent crude oil, it is also a very, very similar picture. Right now, it is actually testing, technically, it is testing the high that we saw back in April 2024 during the when the market was very, very volatile. And we might also potentially see a push up higher to the $95, which is very similar to what we saw in WTI, right? So you can see similarly, we can see that oil has been on a tear over the past week, and Brent crude oil has been up 30%. Now, if you're thinking of like, oh, we should enter oil now, that might not be entirely good idea, right? Unless geopolitical tensions continue to increase, the moment where we can see any inkling of Trump, any single words from either party signaling that the war might tame down even just a little bit, or even the Straits of Hormuz ships are beginning to move across, and that's where you might see oil prices reacting to this news very, very drastically. The rule of thumb is never to always chase, always to follow the technicals. And at least right now, we are seeing both WTI and Brent testing that resistance. And we are seeing the same thing on VIX. This is the volatility index. Now, this is the daily one, because for VIX, we do want to see what actually happened on a day-to-day basis. As you can see, on Friday, we have broken above that previous resistance that was formed back in October. To be exact, it is at this level at 28.96, and now we have went above to 29.48. This is the exact level that we saw in March, which is Liberation Day. In fact, we did actually test higher on that day, and we closed right at that level. Okay, so right now we are at the resistance point. And of course, technically speaking, if we're looking at it from a technical point of view, we might potentially see that pullback from here, because it is at this resistance, a very, very strong resistance area over here. But if we were to see more tensions, and you can see that the next level is going to be pretty high, where will be the next level of VIX will be testing, it will roughly be around that 35 area, a very, very small region, of course, back in April 2025 over here. So, but this level over here at 59, I would say that this is once in a lifetime, unless something super huge happens, like World War III, signs of World War III actually going to happen. This is something that is very, very high, but as of right now, it is still facing a very, very strong resistance, and hopefully we do see that pullback, because in terms of VIX, it has been respecting both the resistance and the support very well over the past few years. Now, let's take a look at the 10-year Treasury yield, because this is also one of the most important indicator for the broader market, because 10-year yield actually reflects what investors expect in terms of economic growth, inflation, as well as the Federal Reserve policy. And right now, you can see that yield for the past week has been actually moving up. In fact, it has been trying to balance between two forces. On one hand, weaker economic data like the jobs number we just discussed. This will normally push yield lower, because investors will be expecting rate cuts. But on the other hand, rising oil prices and tensions are increasing the risk that inflation stays elevated. So what the bond market is essentially trying to price right now is this: will the economy slow down enough for the Fed to cut rates, or will inflation stay sticky because of energy prices? So you can see we are in this awkward situation right now. And of course, we can see that why the yield is also increasing over the past 5 days, it is also the risk of stagflation. Now, stagflation is basically the situation, is one of the worst case scenario that can happen for the economy, where you can see inflation on a very, very high note going up higher, unemployment also going higher, but the economy, the GDP growth of the economy, it is not growing, right? And we are starting to see signs of that, right? With jobs report being weak, unemployment creeping up slowly, and together with what we are seeing with the Middle East oil prices pushing inflation higher. So now this is a very awkward situation for the Federal Reserve right now, even though for the current Fed chair, Jerome Powell, he is leaving in 2 months' time, leaving in May, right? And for the next Fed chair, Kevin Walsh, is he a hawkish guy? Is he a bearish guy? That is the uncertainty that the market is unsure of as well. Now, so we will have to look ahead to next week, and one of the key events market will be watching is the core CPI results. So this will be very, very important, because this will actually reflect, oil prices increasing? I don't think so. It will actually reflect what are the core inflation rate for February. So we might not see the full extent of the oil prices being reflected in this core CPI. But if we were to see this creeping up, this is going to add another layer of uncertainty to the market. And this will be super important to monitor together with unemployment that we saw last week moving forward. So geopolitical tensions as well for this upcoming week. Now, moving on to companies, there were also some news circulating around about Oracle and OpenAI to end plans to expand their flagship data center. Okay, so this was also something that shocked the tech market because, as we know, Oracle and OpenAI, they're all part of the AI revolution. And this does not only involve both of them. It involves companies like NVIDIA, involves companies like AMD, Broadcom, basically anyone remotely involved in this AI revolution because all of them are supplying to these customers. Now, but it's also very, very important to clarify what is actually happening here. Over here, we can actually see some fear spreading around because of this. In fact, some people say that this news by Bloomberg is actually not to the full extent of what is happening. So if you read this, right, what it actually says is that by the power will not be available for at least a year or so. And by the time it is open, OpenAI do not want to expand the cluster of NVIDIA Blackwell chips because the next generation of chips, Vera Rubin, will actually be there. And OpenAI would rather buy the new generation of chips for another data center. That was one thing, right? It is not that they are cutting because they have broken this partnership of Oracle, but they are cutting, they are pausing it. I will not say totally the deal has been cancelled, but they are pausing it because they want to buy the next generation NVIDIA's chip. So this is in a way more of a strategic shift rather than a full shutdown of this AI infrastructure growth. And last but not least, you can see that NVIDIA is also helping Crusoe trying to lease the rest of the site to Meta platforms, and Meta platforms talks are still in the early stage. So Meta are still exploring partnerships right here. So is it a done deal that this data center will not be expanded? Not really. Now, we also saw earnings of a very strong company that is supplying to the AI space, which is Marvell. So they also have a similar business model to Broadcom, and they had a very, very strong forecast. And you can see a bullish multi-year outlook on AI chips. So they are similar to Broadcom, right? Broadcom is projecting more than 100 billion in AI chip sales next year. So this is signaling demand that is spreading beyond AI as well as NVIDIA, AMD. And both Marvell and Broadcom, they are providing similar solutions as well. They enable high-speed connection between the processors, and they are also vital. So with Broadcom signaling a very strong outlook together with Marvell also signaling a very, very strong outlook, what this tells us is that this AI build-out is still not finished, right? Even though we are seeing these short-term geopolitical tensions that is leading the headlines, but the truth of the matter is in the long term, AI infrastructure growth, AI build out in terms of the next phase, agentic AI, it is still looking very, very strong. Now, looking at the charts of Marvell, you can see that the price actually pushed all the way up to test a very, very strong resistance area around the 92 to 94 dollars, and actually pulled back on the day itself. And when we look at the weekly, you can see that it is actually tested the resistance at 94 very, very strong. So will we actually break the resistance? It is actually hard to say, but we saw Broadcom. If you look at Broadcom once after they reported their earnings, the next day, so they reported on Thursday, and similarly, Broadcom actually tested this 50 and 100 daily EMA. And the next day, which was on Friday, they did actually try to break above, but it failed and it closed below. So in terms of Marvell, I think we might see a similar picture over here, especially as it's very dependent, right? It's very dependent on what news is going to come out on Monday, because with all of these earnings, most of the big tech earnings out of the way, all the focus will just be on the macro events, right? Which is the US-Iran war. Most of the eyes is on there now. So if you do see that, oh, oil prices is starting to creep up higher and higher, and that's where you might see this resistance being tested. Very, very strong. It's being tested. It might actually pull back. But if you're seeing some news of the tensions actually relieving, then you might see it break above the resistance. So you can see of what I shared in today's video, a lot of it is very, very dependent, not just on the data of the CPI that is coming next week, but very, very dependent on this short-term outlook of how the war is. So we don't have a very, very clear consensus right now. Is Iran leaning more towards a surrender? How long will the war going to last? What is Trump going to do next? So when we put everything together, we can see the market right now is balancing several forces at once. And of course, the more predominant one is the US-Iran war. every single day we are seeing new news popping out. 2 days ago, we will see that U.S. oil tanker were being attacked, and yesterday, what we saw was, the Russia is entering the fray. So many news are happening along the way. Trump is asking for unconditional surrender, right? And couple that with the economic data that we've seen, we can see that the picture is not looking so good. And all of these combinations creates that high level of uncertainty, which is why, especially on Friday, there was increased volatility, VIX at its all-time high in a recent few months, and equities testing very, very key support levels. So going into next week, it is going to be very, very important, right? Because this core CPI will be the one that will actually cause the market more panic or give some relief. And as you can see right now, all three of the major indices are at that key support level. So it is dependent on the data, it is dependent on the events, what's going to transpire over the next few days, whether will we stand to hold that support or not. Now, that's all that I have for you for today's video. If you do enjoy such market update content, be sure to hit that like and subscribe button down below. It will really help me to create more of such content for you. So thank you, and I'll see you in the next one.